Welcome to Principles of Accounts, a concise introduction to the core concepts and practices that guide financial reporting. In the next sections, we will cover foundations like the accounting equation, double-entry bookkeeping, key principles, and the main financial statements, giving you a practical framework to understand how businesses record and communicate financial information. This slide lays out our roadmap for the session, starting with what accounting is and how the accounting equation works, then moving into double-entry bookkeeping and fundamental accounting principles, followed by an overview of financial statements so you know what each report shows and why it matters for decision-making and compliance. We continue the agenda by comparing accounting standards like GAAP and IFRS, examining assets, liabilities, and equity in more detail, and wrapping up with practical applications and the overall importance of accounting in planning, control, and communicating financial health to stakeholders and investors. Accounting is essentially a systematic process for recording, measuring, and communicating financial information so stakeholders can make informed decisions. Think of it as the language of business that organizes transactions into meaningful reports used for compliance, planning, and performance evaluation, helping managers, investors, and regulators understand what's happening financially. Accounting matters because it tracks a company's financial performance and position over time, supports strategic planning and resource allocation, ensures regulatory compliance and transparency, and allows meaningful comparisons across periods and between organizations so decision-makers can act with confidence based on reliable financial data. The accounting equation, assets equals liabilities plus equity, is the foundation of the balance sheet and double-entry bookkeeping. It ensures every resource a business controls is matched to a claim, either from creditors or owners, so the financial picture stays balanced and consistent across all records and statements. Assets are the resources a business owns or controls that are expected to provide future economic benefits, ranging from cash and receivables to inventory, equipment, and buildings. Assets are classified as current or non-current based on how soon they'll be converted to cash or used, and they form the left side of the balance sheet. Liabilities are obligations or debts the business owes to external parties and represent future outflows of economic resources, including loans, accounts payable, accrued expenses, and taxes. Liabilities are classified as current or long-term depending on their due dates, and they tell users about the company's short-term and long-term obligations. Equity, often called owners' or shareholders' equity, is the residual interest in assets after deducting liabilities and represents the owner's claim on the business. It includes capital contributions and retained earnings, and it's calculated as assets minus liabilities, showing what remains for owners once obligations are settled. Double-entry bookkeeping records every transaction twice as a debit and a credit, which keeps the accounting equation balanced and creates internal checks and balances for accuracy. This standard practice aligns with GAAP and IFRS, supports reliable financial reporting, and helps quickly detect errors or inconsistencies in the accounts. When thinking about debits and credits, remember the simple rule of effects. Debits increase assets and expenses while decreasing liabilities and equity, whereas credits increase liabilities, equity, and revenue while decreasing assets. Using these rules consistently ensures each transaction impacts the correct accounts and keeps the books balanced. Some key accounting principles guide how transactions are recognized and reported. Revenue recognition tells us to record revenue when it's earned, rather than when cash is received. The matching principle aligns expenses with the revenue they generate, and the cost principle records assets at original purchase cost unless adjustments are required. Continuing with fundamental principles, the going concern assumption treats a business as continuing indefinitely, unless evidence suggests otherwise. Consistency requires using the same methods across periods for comparability, and full disclosure means reporting all relevant financial information so users can make informed assessments. Additional core principles include the accrual principle, which records transactions when they occur rather than when cash changes hands, materiality, which requires disclosure of all significant information while allowing omission of trivial details, and conservatism, which advises being prudent by anticipating potential losses but not gains. The three main financial statements give a complete picture when used together. The income statement shows performance over a period. The balance sheet presents a snapshot of financial position at a point in time, and the cash flow statement tracks actual cash inflows and outflows to reveal liquidity and cash management. The income statement, or profit and loss statement, reports revenues, expenses, and net income for a specific period using the formula net income equals revenue minus expenses. It reveals profitability and operational efficiency, making it essential for assessing performance trends and management's effectiveness at generating returns. The balance sheet, also called the Statement of Financial Position, shows what the business owns and owes at a specific date and must always balance because assets equal liabilities plus equity. It provides a snapshot of financial health and solvency that investors and creditors use to evaluate risk and capital structure. The cash flow statement tracks actual cash movements in and out of the business across three sections: operating, investing, and financing activities, helping you understand liquidity and the company's ability to meet obligations. And it complements the income statement since profit does not always equal cash. This slide compares accounting standards. GAAP is a rules-based framework primarily used in the United States, while IFRS is a global, principles-based framework adopted by many countries. Both aim to ensure transparent reporting, but they differ in specific treatments and presentation requirements, which can affect comparability across jurisdictions. Recent updates in 2026 include new standards and improvements that companies need to monitor, such as upcoming changes to profit and loss presentation, adoption of updated revenue recognition models in certain frameworks, and a broader emphasis on transparency and consistency that will affect comparative reporting and disclosures. A chart of accounts is a complete listing of all accounts used in a company's general ledger, organized by category like assets, liabilities, equity, revenue, and expenses. It provides the structure for recording and organizing transactions and is customized to reflect the business's operations and industry reporting needs. In practical terms, accounting supports business planning and budgeting, ensures accurate tax preparation and regulatory compliance, helps with investor relations and securing financing, and enables performance monitoring and cost control so managers can make informed operational and strategic decisions. To summarize, the accounting equation underpins all records. The double entry system ensures accuracy and balance, core principles guide consistent reporting, and the main financial statements together provide a comprehensive picture of a business's financial position, performance, and cash flows for sound decision-making. Thank you for joining this overview of accounting principles. If you have questions or would like examples applied to your own business, feel free to ask and we can walk through practical illustrations or specific statements together.